For most of you during your working years, you have received a paycheck with roughly the right amount of tax deducted. But when you hit retirement, that completely changes. You'll likely have 5 to 10 income sources in retirement, and each source will be taxed a little differently. And if you aren't prepared, it can get quite confusing, and in some cases, cost you thousands in unnecessary taxes. In this video, I'll walk you through how each of the different income sources in retirement are taxed. I'll share some strategies on how you can minimize your tax bill, and we'll also cover some key tax credits that every retiree in Canada needs to know. So first off, what are the key retirement income sources that a lot of you have? And according to a poll recently done by CIBC, we can see that the majority of you have CPP, the Canadian Pension Plan, OAS, the Old Age Security Benefit, and then from there it's the RRSP, TFSA, pension, RRIF, which would jump into the RRSP, GIS, non-registered, and so on and so on. So you can see that for a lot of you, the majority of your retirement income is going to come from your Canadian Pension Plan and Old Age Security and some personal savings. First off, let's start with the government benefits, CPP, Old Age Security. So while I believe that the Canadian Pension Plan and especially the Old Age Security should not be taxed, they unfortunately are both taxable income to you. So as you start drawing down on your CPP and Old Age Security, OAS, you will be taxed on that income. It's taxable income to you. Now, by default, when you start taking that income, there isn't necessarily withholding tax. Now remember, withholding tax is just prepaying your tax, much like when you were an employee and your employer took off tax, remitted it to CRA. So at the end of the year when you did all your tax return, you didn't owe a big tax bill. That's the same thing with withholding tax. It's just remitting some money to CRA. So your CPP and your OAS by default won't withhold any tax, but you can request to have tax withheld. So again, figure out how much tax you should have withheld and move forward from there. If you're not sure, then again, you want to sit down with your financial planner. What does your financial plan say? What's your average tax rate? What's the total amount of tax that you owe? If you're not sure and you want to default to something, default to 20 to 25%, and then that will at least have some remittance. What you don't want is to get to tax time and owe a big tax bill and not have money saved up. So by having some money withheld at source, it's going to help ease that burden at tax time. Now, the first couple years of retirement are really unique, and I'm going to talk about that here in a second. And every single retiree that we work with, that we talk to, faces this challenge, and I'll cover that off here in a minute. So much like your CPP and OAS, when you pull money from your RRSP or your RRIF, your retirement income fund, that's also going to be taxable. It was a tax deductible contribution going in, but it's taxable coming out. Now, the idea was hopefully you were in a higher tax bracket when you put the money in than when you're pulling the money out. So it was a net benefit and it's grow tax deferred. Now, I know a lot of you are going to type already, RRSPs make no sense, they're a scam. If you think RRSPs are a scam, you need to do your research. They're a great tool to grow wealth for retirement. Now, so far we have CPP, OAS, and your RRIF account, which comes from your RRSP. When you retire, you want to convert your RRSP into a RRIF, a retirement income fund, start drawing money out of that. So those are your three main income sources for most Canadians in retirement. Now, all three of those are considered as taxable income. So the top three income sources in your retirement are all taxable. Now, again, for your RRSP to RRIF, your RRIF will have a minimum. It's based on the account value at the end of the year and your age. There's a multiplier. Every age, there's a different minimum. So at age 65, the minimum is 4%, meaning that you need to take out at least 4% of the account value at the end of last year. So let's say December 31st, the account was worth $200,000 and you're 65 years old. You need to take out $8,000 as a minimum amount. You can take out up to $200,000. There's no maximum amount on a RRIF account, but there is that minimum. One thing you need to be aware of is there's no withholding tax on that minimum amount. So again, let's go back to our last example. You have a $200,000 RRIF, you're 65 and you need to take out $8,000. If you only take out $8,000 that year, there won't be any withholding tax. But even the minimum amount is taxable income. Anything you pull out of a RRIF account is going to be taxable income. So just be aware of how that tax works. So the minimum amount on your RRIF, there's no withholding tax. Above the minimum amount, there's going to be a withholding tax based on the scale. So across Canada, Quebec's a little bit different. We'll link that below. But for most of Canadians, it's going to be from $0 to $5,000. Above the minimum will be a 10% withholding tax. From $5,000 to $15,000 is 20%, and above $15,000 is 30%. Now again, you're only withheld on amounts above that minimum amount. So as you build out your retirement plan, understand how much withholding tax will actually happen versus how much you expect to pay. Because there may be a drastic difference between what you're actually paying in tax and what you're going to have to pay in tax at tax time. Maybe you're going to get a refund, but maybe you have a big tax bill. Are you prepared for that? And where is that money going to come from at tax time? The three other main income sources in retirement would be a pension, so defined benefit pension plan. Again, those are few and far between nowadays, typically government workers. Some big companies still have them. But this is a guaranteed income. Sometimes they're adjusted to inflation, sometimes not. But it's all taxable income. If you're someone with a defined contribution pension plan at work, when you retire, that's going to convert into either a LIRA or an RRSP, a locked-in registered account or an RRSP. Those will then be drawn out through a RRIF or a LIF. Again, if you need to learn about that, we have videos on that. Check out those videos. If you have a defined contribution plan, how does that work? We have videos on that. You want to understand the flow of funds when you hit retirement and how they're taxed. The last two accounts that you may be drawing down in retirement are a little better from a tax perspective. The first one is a non-registered account. Some of you call it a margin account, but it's a non-registered investment, meaning that it's not money in an RSP or in a tax-free savings account. It's just an investment. And anything that you earn in there on an annual basis is going to be taxed in your hands. Interest income is taxed at your marginal tax rate. Capital gains has a more preferred tax rate. There's also dividends that kind of fall in between both a capital gain and interest. But again, you can kind of structure that with everything else, but that is a big income source for a lot of Canadians. And there's a lot of tools to structure your non-registered account in a way that you're not getting clawed back on old age security, right? You want to be careful how much interest income. So if you have an RRSP, a TFSA, and a non-registered account, what types of investment in which account really matter from a tax perspective. And we're going to cover that in a future video here in a few weeks and break it down even further on how you should structure your accounts to make sure you're getting ready for retirement to A, reduce your tax bill, and B, make sure you're avoiding any OAS clawback. Now, the sixth and final account I want to highlight is the TFSA, the tax-free savings account. And this is an account where you're contributing to the account with after-tax money. So you've made your money, you paid your tax, and now you're putting it into your tax-free. But the tax-free savings account grows absolutely tax-free. You can take it out anytime, no tax owed. So it's a very nice, what I call a lever account in retirement, where if you need a little bit more money, but you don't want to drive up your tax bill, it's a good account to pull from. If you don't need as much, maybe you pulled extra from your RRSP for tax planning purposes and you don't need it, you can put it back into your tax-free savings account. So the tax-free savings account is a very powerful tool as you enter retirement. So if you're someone getting ready for retirement and you haven't built up your TFSA yet, you want to start doing that. Again, if you want to learn about TFSAs, how they work, contribution limits, all of that, we'll click that video above. Check that out, learn more about a tax-free savings account, and make sure you're utilizing it for retirement because it is truly the only tax-free account and income source that you can generate in retirement. Now, one of the biggest challenges retirees face, especially in that first 1 to 2 years, and this happens to our clients that, we're working with ongoing and nurturing that and holding their hand through the process, it's still a bit confusing to the average person, and it makes sense why. Is some of your income is taxable, like I talked about earlier, but some is not taxable. Some you can start right away. Some you can delay, like your CPP, OAS, you can delay. You can delay taking your RSP, you can delay TFSA. Like there's a lot of movement when it comes. And that's why I say when you have 5 to 10 income sources and you can kind of shuffle it like a puzzle piece to make it work best for you, it's hugely beneficial from a tax perspective, but it can be a little bit confusing if you don't have a good plan in place. So when we build a plan, we can show you, here's the exact amount of tax you're going to pay. Here's your marginal and average tax rate as well. But we can say, look, your taxes for this year is $10,000. Based on the plan and the cash flow coming in that we have lined up for you, there's only going to be $5,000 of withholding tax, meaning that you're going to owe a $5,000 tax bill at tax time. So typically for a client like that, we're going to request more tax being withheld. Again, either the client could save up a little money or we're going to have more withheld. Now, I prefer, if it's more than $3,000, I prefer to have it withheld just so we don't run into installments down the road. But again, there's some tax planning there. We typically see in the first few years of retirement, not enough withholding tax happening. And the end result is clients have to pay taxes on their tax return. So you have to be very careful. As long as you have a good tax plan that shows you're paying the minimum amount possible, but if you still owe tax at tax time, hey, you've held on to that money in the meantime, maybe you can do something with it, earn a little bit of interest, and then pay the tax at tax time. And then year 2, things usually start to flush out a little bit better. I want to highlight some strategies to minimize your tax. So we've talked about the key income sources. And again, those are 6 of the main ones. There's going to be some other peripheral ones that you may have coming in, maybe an RRSP, Registered Disability Savings Plan. There's many other income smaller sources that you could have, but those are the main 6. So how do we actually structure things and look at kind of the way you structure your retirement income and cash flow to make sure that you're strategically drawing money to reduce your tax bill? The first and easiest way is if you're married or common law, make sure you're income splitting. Now, not all types of income you can income split. So you need to make sure you understand that. Again, we'll link that video above and we'll link all these videos below as well. If you don't want to click on there and get off this video, we'll link all these videos below so that you can continue to educate yourself to make sure that you're putting yourself in the best position when you enter into retirement. But pension income splitting is something that if one of you have a very high income and one of you have a very low income, if it's the right type of income that the high earner has, you can shuffle some money to the lower income earner on your tax return to reduce your overall tax bill. Again, because we're in a progressive tax system here in Canada, we pay less income tax on lower income amounts. So instead of having, 100,000 and 20,000 of income, let's make them both at 60. And overall, the household's going to pay a lot less tax because we're taking income from a high tax bracket and shuffling it to a lower tax bracket. Thus, it's a net benefit to the household as far as how much taxes they're going to pay. A second option, and I don't see this a lot, if you do other planning, this isn't as important, but it is a tool, and that's to share your CPP. So if you have, again, married or common law, and you can have 2 people collecting CPP in a household, if they're lopsided, one person's collecting $1,000, another person's collecting, say, $400, you can level that out a bit. Again, there's rules around that, how much you can level out, depends how long you've been together, et cetera, but that may be a tool to kind of level out so that that person with lower income is brought back up to a bit of a higher watermark. Again, lowering your average tax rate and leveling that out between the 2 people. Again, as you go through retirement, if you are married or common law, you want to make sure that the 2 of you have very similar average tax rate, very similar taxable income sources. You want to level that out. You don't want one high, one low. That's a very inefficient plan. And if that's your plan, you need to make adjustments today. So I want to go back to the RRSP to RRIF. So when you retire, you want to convert your RRSP to a RRIF. Now, a really good plan typically, 99% of the time, will have you taking more than the minimum RRIF amount. That should be the strategy for, again, 99% of you watching this video. When you retire, you want to convert RRSP to a RRIF and figure out how much you need to pull out, but it needs to be at least a minimum amount. Now, when you convert your RRSP to a RRIF, there's going to be a question on, do you want to base the minimum amount on your age or your spouse's? And a lot of you, if you have a younger spouse, you say, well, I want to do their age because I don't have to pull out as much. The minimum amount is less. But remember, you shouldn't be pulling out the minimum amount out of your RRIF. If you are, you're going to end up paying CRA more money than you should most likely. Again, majority of the time we do thousands of plans for Canadians. You should be pulling out more than the minimum RRIF amount. Remember, if things change in your life, you can always convert your RRIF back to an RRSP anytime before 71. So if life changes, you go back to work, whatever happens, you can always convert it back. So that's kind of the fallback there. But convert 100% and don't worry about basing it off the younger person. You can do it, there's no harm in doing it, but there's typically no benefit to do it either. Another tip for you, and this is a huge one, is to utilize the TFSA, the tax-free savings account, efficiently. And I like to call it my lever account. So as you go through retirement, you want to have a lever account, meaning that if you need a little bit more money, you pull it out of that account. If you don't, if you have extra money, you put it back in that account. So for some of you, it's going to be a non-registered account. For some of you, it's going to be a tax-free savings. If you have a non-registered, that's typically money in, money out until it runs out, and then it's your tax-free savings account. But it's a powerful tool to say, you know what, my furnace broke, I need a little bit of money, let's pull money out of non-registered or TFSA. You want to have that tool in place. If you're retiring with a defined benefit pension and an RRSP, no non-reg, no TFSA, you have a retirement plan with little tax flexibility. There is flexibility. We can always do some planning around that. There's flexibility that we can create. But if you start building up that TFSA account leading up to retirement, trust me, you're going to be in a much better position, have more flexibility, and just have a better overall plan and flow of funds. Another way to minimize your taxes in retirement would be to wait on taking your CPP and allow yourself to draw down that RRSP or the RRIF account up to age 71. A lot of you wait till 71, you're forced to take the minimum. You kind of leave this thing, right? That's your parents' generation. For most of you watching this video, your parents' generation was really good at paying a lot of tax, and we thank them for that. But let's change that. Let's actually do some tax planning. Taking CPP early, not touching your money, taking the minimum at 71, leaving that big account till 80, 85, 90, that's typically a really bad tax plan. And for a lot of you, that's what you're doing. The reality is when you're working, kind of the tax planning was very simple. The accumulation phase, in my opinion, is very simple. It's hard to save money, but as far as like the structure and stuff, it's fairly straightforward compared to retirement. When you hit retirement and you have this decumulation phase, it's much more complex. When to take stuff, how to take it, how to structure it. There's a lot of tax planning, which is great. Finally, all of us employees get tax planning. We can actually do tax planning. We can choose to pay less tax. Yet, most of you watching this video, over 50% of you watching this video, are paying way more tax than you need to be paying because you're making bad decisions through retirement. And these decisions can be fixed. Talk to your financial planner. If you need help with this, reach out to our office. We'd love to help you. parallelwealth.com/planning. You can learn all about our services, how we can help you. Yes, there's a cost up front. Yes, you will save that cost many, many, many times over, have a clear plan, and pay way less to CRA. So again, get a proper plan in place so that you know what to do, when to do it, so that you put your money back in your pocket. You've worked 30, 40, 50 years to get to this point. You've saved, you've sacrificed to get to this point. And now you're just kind of like DIYing it and figuring it out going forward. And the reality is we're giving too much CRA. Let's change that narrative. The last tax tip I have for you is for those of you that are looking to retire, say next year, 2025, you may want to make a final RRSP contribution in that last year retirement. Now you'll have up to March 1st of 2025 to get a contribution in for 2024. Again, if you're watching this in a year from now and it started 2026, like the year before you retire, or the year of retirement essentially, is you want to look at, does it make sense to make that final RRSP contribution? For a lot of you, it's going to. How much? Do you have contribution room? There's a lot of variables there that you need to look at. But again, this should be mapped out. And that's why it's good to get a good retirement plan in place a few years before you retire. I always say 5 to 10 years is a sweet spot. Most of our clients hire us 1 to 3 years before they retire. They have a bit of a runway. We can make adjustments. We can look at RRSP contributions. There's many things we want to look at, so that when you're leading up to retirement, we can make those adjustments to put you in the best position for retirement day. Now, there's 3 main tax traps that we see a lot of clients fall into. And the first one is OAS clawback. You haven't planned accordingly. Sure, you may be stuck with it, but it can be reduced. How does that work? You need to have that in your plan. Another trap is not planning for the minimum RRIF withdrawals. And we've had a few clients over the last few weeks come to us and say, I'm turning 71 this year. I got to convert my RRSP to a RRIF, and now I got to take out this extra money. There's a minimum amount, and now I'm going to have OAS clawback. And like, I wasn't planning for this. I forgot about it and whatever else. This is why it's important to start planning as soon as possible, as soon as you retire. Figure out like, how big is your RRSP when it converts to RRIF? How much am I going to take out? How does it structure? How does it integrate into every other income source that I have? So don't be caught off guard. In the year you turn 71, you have to convert your RRSP to a RRIF. And in year 72, you have to start taking money out. That's the reality. How does that work within your overall tax and cash flow plan? Make sure you understand that before you actually get to that age. And the third tax tip is avoiding or not paying attention to our progressive tax rates. We have to pay tax, but there's a good way to pay less tax, and that is to look at your average tax rate. As we lead up to retirement, we're putting money in RRSP and all that, looking at your marginal tax rate is most important. As you go through retirement, you want to look at marginal, but more important is your average or your effective tax rate. If we can keep that as level as possible, typically within 1 or 2% ideally, from now through retirement, then I know that's a pretty good plan. There's obviously other nuances to it, but you don't want a 0 year and a 30 year, and a 0 year and a 25, and then a 5 year and a, like, don't let it bounce all around. If you're bouncing all around in retirement on your average or effective tax rate, I can almost guarantee you're paying way more to CRA than you need to. You need to level that out. Now, for most of you watching this video, there are 4 main tax credits as you lead up to and into retirement. And we're going to link all 4 of those below. I won't cover them off all in this video, but I do want to list the 4 here. So the first one is age credit, which happens at age 65. The pension income tax credit, which we have a video on, we'll link that below as well. the medical expense tax credit, and the disability tax credit. So those are the 4 main tax credits that we see our retired clients use. So make sure you understand what they are, how they work, and how they will benefit you through retirement. The last tip I have for you in this video to help you pay less tax in retirement. And again, I've said it many times in my videos before, if we can all agree on one thing, and trust me, there's not a lot that we can all agree on, but I think we can all agree that we want to pay less tax, both while we're working and in retirement. We've worked hard to get to this point, we want to pay less tax. So the last tax tip I have for you is get a proper retirement plan in place. For most of you, you've worked with a financial planner up until this point, maybe at your bank, a large financial institution. Whoever that is probably did a decent job, let's say, leading up to retirement. But do they have the expertise to do retirement planning? Not many financial planners in Canada, I find, do. Not many do it, not many know how to do it, not many know the nuances of it. So when you build out a retirement plan, make sure you sit down with a financial planner, a CFP professionally ideally, someone that's trained in this, knows what they're doing, structure, but someone that knows retirement planning. Again, our office, we look after this. We have 8 CFP professionals on our team, and all we do is retirement planning. There's other firms that do retirement planning out there. Find one that's best suited for you. But your financial planner that you've worked with to this point may not be the financial planner that you should have beside you for the rest of your retirement years. They may not be a good fit. They may not be able to do the proper planning. So again, have that conversation with them. Maybe they're honest. Maybe they say, you know what, Joe, this isn't my forte. Like, let's actually bring in a retirement specialist. Reach out to our office. We love to kind of integrate in there. We do a lot of plans for people that already have that advisor or investment person relationship. We build the plan, we make sure it's on track, and then your current advisor can help implement it. Like, there's a lot of different options here. But the key is make sure you have a really good plan, retirement cash flow tax plan, that's done by someone that understands retirement, the nuances, the money movement, the tax movement of what happens in retirement, because it's very different than the accumulation phase. Leading up to retirement is very different than retirement on. There's 2 phases to this. As you enter into phase 2, do you have the right team and the right plan on board? You likely don't, so make sure you make that adjustment to get the right plan so that you can pay less tax and just have a clear path forward in retirement.